Thank you so much. It's a great pleasure to be here in Abu Dhabi at Abu Dhabi Finance Week, the capital of capital. CBDC in 10 minutes. It's going to be quite a challenge, but let's get started. So I'm Dr. Ruth. I run my own consulting business, advising central banks, fintechs. I'm also a professor at what used to be called Cass Business School in London, now Base Business School, teaching particularly fintech and digital money and executive training. And I'm also quite well versed in the space of cybersecurity, which is actually increasingly becoming a real challenge for every type of infrastructure and flow of value that we're seeing. But here, I'm here to give you a bit of an introduction on central bank digital currencies. Where does it come from? Why is it so topical for central banks? And where's sort of the real challenge with it? We've seen over the last 5, 6, 7, 8 years, cryptos coming to the fore as an alternative means of value transfer, particularly after the financial crisis. People stopped trusting banks and the whole central banking system, interestingly, particularly also given some of the policies in terms of quantitative easing and everything else we've seen. So there is now a new plethora of asset class to do things differently, but people realized it's volatile. We've seen all the issues with Bitcoin, Ethereum, and others going up and down, particularly in response to social media, as we've heard earlier on the panel. We also now have, of course, stablecoins, which is very interesting because I just came from a panel talking about how stablecoins as programmable money could be used as a wrapper for central bank issued digital currencies. Now, the thing is with central banks, they would like to keep control of the money flow, the monetary anchor. So we do have actually a number of central banks around the world that have now for almost 7, 8 years experimented and collaborated to see whether there is no need to digitize central bank money. If we think about us as citizens of various countries, the only time we ever get into touch with central bank money is physical cash. Central bank money is normally only used in the interbank high-value transfer in terms of settling large transactions. So the question is, should a central bank issue a digital variation of the cash that I'm holding today, in case I still use cash, in order to propel the whole society into the digital economy? And this is exactly one of the key reasons where central banks have been so keen, being inspired by cryptos and all the technology advancements, to understand where is their role in terms of the relationship with the citizen of a country in terms of the money, because if physical cash continues to dwindle in response to COVID, in response to further digitization and automation of businesses, then of course you no longer have practical use of cash in most of the outlets you want to spend. Is there therefore a role for digital cash? Now, we all know that today we have global card schemes. Everybody in developed countries has some sort of access to debit cards, credit cards. So there are already a number of retail payment instruments that we do have at our disposal in terms of transacting into the digital economy. We heard on the earlier panel instant payments. We heard this morning about open banking, open finance, a number of initiatives over the last few years, both regulatory standards and market developments, that really try to accelerate the use of electronic commercial bank money, the money that sits on your bank account, in terms of making this account-to-account transactions possible. So more efficient, cheaper for merchants to acquire. So there's already now a plethora of digital means to actually pay. So then the question comes, do we need central bank digital currency as yet another complement on this journey? And central banks felt we should definitely look at this. Now, this is what I'm clicking, and it's not happening, but it doesn't matter. So in terms of the central bank's approach here, we have two key models on CBDCs, retail and wholesale. And what I spoke about until now is all about retail payments and turning central bank money into a digital variant. Of course, we do know that cash as a bearer asset is really rather anonymous. If I make a cash-in-hand transaction, people can't really trace it very well. They do trace it when I take cash from the ATM, and even when I pay in a shop that has obviously cameras everywhere. But when we think about CBDC, the idea is not to make it anonymous. Central banks would obviously settle the transaction on their ledger, and they need data for that. So any type of digitization of central bank money, whether it's retail or wholesale, will inevitably require identification of the individual, onboarding into a digital wallet, and then also the transactional processing, where you require data on the ledger of the central bank to ultimately settle. So if I think about my work in terms of what I'm doing with the Bank of England, for example, a very big question is around privacy. How private are my transactions in CBDCs compared to physical cash or compared to other digital alternatives? And the reality is, of course, it's no longer going to be private as the anonymous cash variation. Think about the policy trade-off. I just called out privacy, which is a very sensitive topic for some countries more than others. The other one's, of course, financial stability. Particularly a few years back when we had the sort of crypto hype in phase one, central banks were very concerned that they would lose control over their monetary policy if too much flow would go through alternative system outside the central banking system. So financial stability is a key concern for central banks in this journey. Financial inclusion, interestingly enough, or maybe not surprisingly, many central banks do not see CBDC as a key financial inclusion policy, because financial inclusion implies that the actors regulated in the market can maybe offload the KYC to the central bank, and that's certainly not what the central banks want to do. So what we tend to see is that most central banks are saying, we would like the private sector to deal with digital wallets, to deal with the transaction initiation and the flows between entities, to deal with the conversion from my bank account, commercial bank money into CBDC and back. And the central bank, as they do today, is running the CBDC ledger where all the data will be held, all the CBDC will be held, and they just look at the settlement side. Another key opportunity, of course, is innovation. We heard this morning from the Central Bank of Abu Dhabi that they're creating an innovation platform based on a new real-time infrastructure where you can ultimately look potentially at different digital assets, commercial bank money, potentially one day CBDC, digital assets, crypto, stable coins, so that you're starting to create a much broader interoperable environment for different digital assets, which is really the opportunity here. When you think about the design, I would argue that for most countries, a retail CBDC as an additional tool, in addition to all the other digital payment instruments you've got, is maybe not such a big burning platform need. However, wholesale is a different question, and wholesale is all about interbank settlement, which is already happening in central bank digital money, if you so wish. But there the question becomes, are we creating a new infrastructure at the central bank level which is potentially running on different technology, distributed ledger, as an example, blockchain, where I can design a system that is multi-asset, instant settlement, atomic settlement, as you would call it on a blockchain, and where I can start to issue a bond, I can trade a bond digitally, I can pay for the bond with commercial bank money, with stable coins, with CBDC, and all of this can happen more or less instantly on one big infrastructure. You're starting to reduce the whole cost chain of all these different infrastructures and silos, regulated fiefdoms of CCPs, CSDs, registrars, and everything else. So the innovation and efficiency potential of wholesale CBDC, even from a domestic perspective, is really significant. Now, the biggest challenge, of course, is always cross-border payments. How can we use CBDC in cross-border? And that's something where central banks will tell you, hold on, I don't want my money to be fungible in the sense that a foreign bank can hold my currency in a digital way. However, you want to enable transactions cross-border. And this is potentially where the whole idea of programmable money as a second layer after a CBDC has been issued comes in terms of a potential stablecoin wrapper to wrap around the CBDC so that an individual, an SME, a business can start to transact CBDC cross-border irrespective of any missing interoperability between central bank CBDCs, because you're using technological programmability around it that will allow a central bank to still trace and make sure that they know where the currency actually lands. Now, any questions? We've got 22 seconds, and of course, I don't have time for questions, but suffice to say that we are at an early stage of the CBDC journey. We have not seen any significant market roll it out, neither retail nor wholesale, but we have a lot of incredible collaboration within the Bank of International Settlement community, where I know the UAE is playing a really big role, and we do see more regulation coming into crypto, stablecoin, and ultimately impacting the viability of CBDC, both domestic and cross-border. So early stage, it's going to happen, and it will be very interesting. So reach out if you want to know more. Thank you so much.